A rare treat and certainly an important time to speak to Bill Dudley, president of the New York Fed. He's been there since 2009. He joined the New York Fed in 2007 to run the markets desk. Prior to that, chief economist at Goldman Sachs. So not only the perfect time to talk to you, Bill Dudley, and welcome, but also just to bring to our viewers and our listeners that you have many perspectives on what's going on. And even though yesterday you very clearly and articulately said, look, this stock market sell-off on Monday is something that's not an issue for central bankers right now, hasn't changed my economic outlook. The stock market sell-off continues today. And what's interesting is it came on the back of the bond market sell-off, which was hit by Mark Carney, head of the BOA, simply saying, it looks like we might have to raise rates a little more aggressively. Is it beginning to feel like maybe this isn't just a one-day sell-off, a one-day event?
Well, I don't think we know now, but clearly the market is adjusting to the fact that the global economy is growing quite quickly. And as a consequence of that, monetary authorities around the world are either starting to remove accommodation or are thinking about starting to remove accommodation. And that's a little different from the environment we were in the prior, 7 or 8 years. So bond yields have moved up, and as bond yields have moved up, that's put a little bit more pressure on the equity market, and I think the equity market has adjusted in response. Now, in terms of what it means from the central banker's perspective, this is all about, magnitude and duration. The little decline that we've had in the equity market today has virtually no implications for the economic outlook because it precedes a very, very large rise in the equity market over the last few years. So if it stops here, the implications for the economic outlook are very marginal, and so probably not going to change our thinking about the economic outlook. If it were to go on much further, and be much more persistent, then it could start to affect household and business spending behavior, and then that could actually start to influence the economic outlook. But so far, I'd say this is small potatoes.
But I also want to put on the table that as I was thinking about this and talking to you today, I was thinking about 2015. When we came into the year, the Fed's going to hike rates in March, and then there was, Brexit, and then there was a big sell-off in the Chinese stock market. It hit U.S. stocks. Fed passes in the summer, passed on a rate hike again in September, only one rate hike that year. So clearly there's a point where markets and market volatility can have a very definite impact on the Fed's path.
I think it depends a little bit about why are the markets doing what they're doing. In the first quarter of 2016, it wasn't just about the markets. Commodity prices were falling very sharply. This is putting a lot of pressure on emerging market economies that were dependent on commodity exports. China was going through a pretty difficult adjustment. So it wasn't a market event per se. It was really things that were actually happening in the global economy. I think this is a little different. The global economy is doing fine.
So I want to look at the sort of the anatomy of where we've gotten over the last week, because you were talking about the economy looking better and markets starting to factor that in and price that in. Certainly there was a jobs report on Friday, but on Wednesday, the Fed's policy statement added the word further twice, talking about rate hikes. A lot of people said, oh, it's a signal they're going to move more aggressively. I said, everyone's overdoing that, but I have to ask you, what was that further intended to signal?
Well, I can't comment for the committee because I'm sure the word means different things to different people. I think from my own perspective, just speaking it from my own perspective, I would say maybe a little bit more confidence in the strength of the economy on the back of more momentum through the end of the year and a large tax cut package. I mean, the two things that have really happened as we went from early in 2017 to now is the economy has picked up momentum. And we've gotten a big fiscal package. And so, and the unemployment rates continue to decline. The labor market stayed very strong. And so, I think, speaking for myself, I have more confidence in the durability of the expansion and more confidence that the Federal Reserve is going to have to continue to remove monetary policy accommodation.
So on Friday, in the jobs report, the payrolls were a little bit stronger than expected. That was not such a market mover. That wasn't the headline that grabbed people. It was the average hourly earnings up 2.9% year over year, up from 2.6%. And they've been stuck around 2.5, 2.6, 2.4 for a while. Bam. Oh, wages finally starting to accelerate. More inflation. Not just 3 rate hikes, 4 rate hikes in 2018 now possible. What do you see?
I think it's going to really depend on how the economy evolves. I think it's really premature to make predictions about whether it's going to be 1, 2, 3, or 4. Clearly, with the December summary of economic projections, the median projection was 3 rate hikes in 2018. That still seems like a very reasonable projection. If the economy looks stronger as we go through the year, could that 3 turn out to be more? Perhaps. On the other side, though, if the economy starts to look softer or inflation doesn't materialize like people expect it to materialize, then the Fed could go a bit slower. So I think that the jury's out. When we write down these summary of economic projections, they're not a commitment to what we're going to do. They're a forecast at that time. And so if the economic outlook changes, then we're going to change what we do. And a good example of that is the one that you brought up earlier, December 2015. As the global economy looked a little bit shakier in the first half of 2016, we slowed down.
So let's take a look at that. I want to look at that wage number in particular, because you have a more robust forecast this year. You're what, 2.5 to 2.75% on GDP, unemployment below 4%, and wages feeding through to higher inflation, especially in services. There's another number in that report that a lot of economists, and you are one, so you know that they look at even more than that overall number. It's non-supervisory workers. It's production workers. That number rose only to 2.4 from 2.3. It has been very flat. It hasn't risen much, Bill. So, is there really that much sign from wages accelerating and starting to move up inflation?
I wouldn't want to put too much weight on any 1 month number because these numbers are pretty volatile month to month. Also, there was a drop in earnings, drop in work week in the last report, and so that also could have contribute to a little bit more firmness in the average hourly earnings. So, I think the question is what's the trend looking through many months? I mean, if you look at the wage pressures, a few years ago we were running about 2%, and then last year the trend looked like it moved up to about 2.5%. So the 2.9% is just raising the question, are we moving to a little bit higher rate of wage inflation? I think, possibly. Certainly there's reasons to think that that could occur because the unemployment rate's low and the labor market's tight. But whether that's actually happened yet, I wouldn't want to put too much weight on one report.
So as we go into the March meeting, you do have colleagues who are more in the camp of saying, let's wait until we actually see that wages are really rising and it is going to boost inflation more. What does Bill Dudley have to see to vote for that March rate hike?
Well, to me, the economy is growing above trend, and I'd have to have confidence that that's going to continue. If the economy grows above trend, that's more pressure on resources, and if there's more pressure on resources, we should see higher wages, and those higher wages should feed through into prices. So it's really about the outlook. It's really about what do I think is going to happen in the remainder of 2018 into 2019. As long as I'm comfortable that the economy is going to continue to grow at above trend pace, at a time that I think monetary policy is accommodative and financial conditions are easy, I'm probably going to be supportive of removing monetary policy accommodation. But again, let's see where we are at the time of the meeting.
What would stop you?
I think if if we saw information that the economy was much weaker than expected, that would sort of change my mind. But I think there's so many things now on the side of the economy being stronger than expected that I think that's, in my mind, that's not that likely. We have above trend growth, we have buoyant financial conditions. We still have an easy monetary policy, and this is all taking place with a very large tax cut that's going to provide additional stimulus.
We also have a bond market that's selling off. Yields are rising. We've had a pretty big jump, 10-year yield from 2.4% to 2.85% in just 6 weeks. Not as bad as a temper tantrum. Nevertheless, it is on the rise, and I think people are still looking at this, wondering how much higher it goes, right, in terms of yield, lower in price, rather than saying, oh, well, when does it hit bottom? You know what I mean? So that seems to be the trend. What does that mean for the path of rate hikes if yields keep rising? Higher rates, higher yields, don't they have to do some of the Fed's jobs for it? Does it maybe suggest that the Fed doesn't need to move so much?
Well, it depends on why long-term rates are moving higher. I mean, long-term rates are moving higher in part because the market thinks that the Fed is going to go forward and continue to tighten monetary policy. I think most of the rise that we've seen in bond yields is really a view that monetary policy around the world is going to become less accommodative.
So this isn't something that you're concerned about, even if it continues? Because here's another thing.
Well, everything is, proportion does matter. Sure. I think that the surprise in my mind was how low bond yields were. When I looked at financial markets, I in a speech I gave recently, I characterized financial market prices as elevated. And I think part of the elevation was not just the equity market, but also the level of Treasury bond yields. They seem awfully low. Let's put it this way. If we just did a thought experiment, I said 5 years ago, The U.S. economy is at a 4.1% unemployment rate. Inflation is running 1.5% for the core PC deflator. But the economy is growing above trend. Last payroll number was 200,000. Where would you think the 10-year Treasury yield would be? You probably wouldn't pick, below 2.5%.
Probably not. So you think the Treasury is the yield is getting more fair valued in the sense of more in keeping with what the Fed thinks it should be?
Well, I think what's happening is the expectations about U.S. monetary policy are the Fed is going to remove accommodation. And I think market expectations have actually come in much closer alignment with what the Fed Reserve has said. This is what we think we're likely to do. And as that's happened, that's pushed bond yields a bit higher. So it seems to me that there's nothing surprising about what the bond market is doing.
I want to come back to something you just said, though, because there's a lot more forecasts now for 4 rate hikes in 2018. Is the bond market getting ahead of the Fed? Are they getting ahead of Bill Dudley? You just said, well, I don't know yet. Even though you've got this robust GDP forecast, is the bond market maybe now getting a little bit too out in front?
Well, I think the way to look at that is to look at what's actually priced in the market. If you look at the Eurodollar futures market, you can essentially extract how many tightenings are priced in. And last time I looked, there was less tightening priced in than the 3 median projections in this December summary of economic projections. So it doesn't. What's happening is before the market was expecting quite a bit less than what we thought was the median expectation. And that gap is now closed. So the gap between what we think is likely and what the market thinks is likely is pretty small at this point.
Okay. Financial conditions. You're the guy actually who invented the financial conditions index.
I wouldn't go quite that far.
Well, but still, you've got the one that everybody looks at now. You had so much to do with that. And the market pretty much had ignored 5 tightenings by the Fed. Financial conditions kept getting looser. People thought, well, this must be very vexing for the Federal Reserve. Now you've got bonds selling and yields rising. You've got stocks selling off, and it remains to be seen how far they go. Are markets getting more in sync with Fed policy now?
Well, I'm not sure that, yes, to the extent I think they're building in a little bit more expectation of tightening, that seems appropriate. Financial conditions, can diverge from the path of monetary policy, and we certainly saw that over the last few years. We were removing accommodation, yet financial conditions were becoming a lot more accommodative. The reason why that's important is if financial conditions are easing a lot, then that puts more pressure on the Fed to do more in terms of removing a monetary policy accommodation. Now with bond yields up, stock market down a bit, financial conditions are a little bit tighter, and so we're going to have to factor that in terms of our thinking about monetary policy. But the moves we've had are pretty small
so far,
relative to what preceded it.
Overheating. In the speech you gave last week, and you've said this at other venues, I believe, you're warning of potential overheating in the U.S. economy. And I've been wondering, what do you mean by this? This isn't the 80s or the 90s, maybe not even the 2000s, globalization, technology, disruptors in every space, it seems. So what is the 2018 definition for Bill Dudley of overheating? Inflation globally won't rise very much. It's still not rising much here. What are you really saying there, Bill?
Well, what we want is a low unemployment rate that's sustainable over time. And what I'm worried about is if the economy is too strong, we'll push the unemployment rate to such a low level that inflation will rise and it won't stop at 2% or 2.25%. It'll just keep going. And at that point, then the Federal Reserve will have to stand on the brakes a bit harder, and the risk of a recession will go up significantly at that point. So I think if the economy is too strong, we could actually have trouble causing a soft landing.
Okay, and you're also a believer that the Phillips curve maybe slope has changed, but it's still there, right?
I believe that if you push the economy to a high enough level of resource utilization, inflation will rise. Yes, absolutely.
Okay. I think it's interesting. From October 2012 to now, the unemployment rate fell from 7.8% to 4.1%. That's almost a 4 percentage point drop. That is really big. Now, that average hourly earnings of production workers figure only rose from 1.2% to 2.4%. Unemployment's down to 4.1%. So to get overheating or to get this increased Phillips curve style in inflation, is unemployment can't go to 0? Is it going to go to 1%, 2%? Is 4 percentage points don't get much more. Why is even 3.5% going to do it?
Well, we don't know exactly where the sustainable unemployment rate is. Now, I think most people think that we're sort of in the vicinity. In fact, perhaps a little bit below what's sustainable over time. So what will be important over the next year or so is, are we actually starting to see an acceleration in wages? If we see that, that would be a confirmation that the unemployment rate is maybe a bit lower than what it can be on a sustainable basis. And if it is a bit lower than what it can be on a sustainable basis, then that will create some impetus for us to continue to remove monetary policy accommodation.
Does this lead to this question of Fed rethink? You know, new chairman at the Fed, this question of your 2% target. You know, if it were 1% to 3% range with the target in the middle, you guys could have declared victory. You know, what does that mean to you?
I think the transition from Janet Yellen to Jay Powell is going to be very smooth because I think they're on the same page. I think Jay is very experienced. He's been at the Federal Reserve for a number of years now. He's voted right along with Janet all the way. So I don't think this is going to be this is going to be evolutionary, not revolutionary.
But would you?
Transition.
But let's take it from on a policy, an economic standpoint.
So look, I think it makes sense for the Federal Reserve over the medium to longer term to sort of consider the inflation framework. But I think that needs to be done, deliberately. I don't think there's any rush. I wouldn't want to move to a new range on inflation today because it would seem like, okay, you're having trouble making 2%, so you're just, moving the goalpost. And I think there'll be a credibility issue for us. But I think in the longer term, once we've actually achieved our objective, getting back to 2%, then I think potentially considering a range for inflation might be useful because, the number of times that we're exactly going to be able to hit 2% is de minimis.
You, in your speech last week, also warn of a day of fiscal reckoning. You're very concerned about this growth in the budget deficit and what it's going to mean about crowding out, potentially pushing up longer term rates. What does it mean for Fed policy? Does the Fed have a role in addressing this? If so, what?
Well, I think the issue is that if the Treasury, if the budget deficit is on a unsustainable course, which it seems to be right now, bond investors are going to start to demand higher interest rates to compensate them for the risk of taking on the debt. And that could make the Federal Reserve's job a little bit more difficult.
Are we starting to see that already? We've seen this rise in bond yields, a little bit less demand at the 10-year. We got a 30-year this afternoon.
I don't think that this is the main issue that's driving the bond market right now. I think it's really more the strength of the U.S. economy, the strength of the global economy, the easiness of financial conditions, the likelihood that the economy is going to continue to grow at above trend pace in 2018. The fiscal discussion doesn't seem to be having a tremendous weight right now. I mean, we're just seeing negotiations in Congress that are going to up spending on both military and domestic discretionary spending significantly. So it doesn't seem like that's a big part of what the market's going through right now.
Does it? If the Fed's on a path to higher rates because it wants to keep unemployment from getting too low and inflation from rising, and the deficit's growing, it's a little bit trickier then because in effect you're going to be helping to push up rates at a time when you're going to, maybe by you, it's not what you're trying to do. It'll be a byproduct of the policy, but it could make it a little more expensive to finance this large and growing deficit at a time when there's going to be so many more bonds issued. And we've got stories today on the Bloomberg about foreign investors just not as eager to come in and snap up treasuries.
Well, the thing I think we need to realize is that debt service costs, which have been kept incredibly low by the low level of interest rates over the last 10 years, are going to likely to go up a lot. Between 2007 and 2017, the amount of outstanding government debt went from $5 trillion to nearly $15 trillion, yet the debt service costs went up only marginally. Now you run that forward over the next 10 years, the debt's going to continue to expand, and interest rates are probably going to be significantly higher. In that environment, debt service costs are going to go up significantly. The CBO, the Congressional Budget Office, estimates that as a share of GDP, debt service costs are going to double between last year and 10 years from now.
Quick final question, Bill, in terms of our TV audience anyway. A guest this week on Bloomberg TV said the biggest risk to the stock market is the Fed tightens too much. Put that to one side or address it. But what's the main indicator now? What's the most important thing you're watching and we should be watching with you in terms of hikes?
To me, it's all about the factors that shape the economic outlook. People always want it to be one variable. This is one thing. There's lots of things that shape the economic outlook. It's the fiscal policy. It's growth abroad. It's the level of interest rates. It's the level of the stock market. It's the value of the dollar. So their consumer and business confidence. So all those things shape the economic outlook. All those factors that shape the economic outlook are going to then weigh in to our view about what's the appropriate monetary policy to follow.
And you can assure us that the Fed won't make that mistake, tightening too much?
Well, we'll try to get it right. I mean, I think the one good news is that inflation's still below 2%. And as long as inflation's below 2%, I don't think the Federal Reserve has, any particular reason to be really aggressive. I think we can be relatively patient. But we also have to recognize that the level of interest rates that we're starting from, right? The target range for the federal funds rate now today is 1.25% to 1.5%. So we're starting from a very low level of interest rates. So it certainly makes sense to get monetary policy back towards neutral before we get the economy, inflation gets above 2%.